Hello, folks. Welcome to State of the Market. This is David Russell, Global Head of Market Strategy at TradeStation Group. It's great to be with everyone. Today is Monday, May 12th, 2025. I'm going to share a few disclosures with you as usual in the chat. So in many ways, we have a kind of back to normal trade. I think when we look at this overall, it's more as a question of a lot of the tariff situation simply being removed. And I think the whole idea of sell America, um, you know, unwinding American assets, selling the dollar, buying gold, all those things have, for now, more or less subsided because of the news we got over the weekend of Treasury Secretary Scott Bessent going to Switzerland, meeting with his Chinese counterparts, and coming back essentially saying that things have, they're going to see significant reductions in tariffs, back down in some cases around 10%, things like that. The exact numbers you guys can look at. We look at indexes here, the big stuff in this webinar. But the key way to think about it is the kind of, um, you know, back to normal trade is really what's happening here. We have the VIX dropping, and we're also returning to what we call a stock pickers market. So I'm going to get to that in a second, but I think the key thing is we had talked a lot about how we had a record run of bearishness, according to the American Association of Individual Investors. Um, it was something like 7, 8, 10 weeks above 50% bearish. We also had a lot of evidence that there was significant cash on the sidelines, and now we're in a spot where that money is streaming back in various ways. So let's also now go to tradestation.com, go down the page, and you'll see an article here. Stocks break out as Bessent slashes tariffs. So that's the article that has a lot of the key things we're going to be looking at here. Now we have this this model. It's kind of a paradigm we use in this webinar and in state of market trends on Thursdays. The idea is that the market goes through cycles of being volatile and everything moving together, and being in a period then of volatility fading and stock picking happening here. And that's essentially where we are entering now, potentially, if this model bears out. The VIX is now back under 20. And it puts us in a spot now where the big indexes will make smaller moves and individual stocks will make bigger moves. We'll see less correlation, more individual stock performance, more stock picking. And that's the kind of environment that we seem to be entering now. So as we look overall at the news, from what I can tell, we really, the China didn't really give very much. It was just a question of undoing what had essentially happened in early April. Um, and I think now, in many ways, the political sort of environment is shifting toward the midterms, and that actually could result in more kind of happy news, so to speak, things that are positive, things that are not as disruptive potentially. So here's the overall article. We outline some of the points in there. And I think in many ways, there's kind of two ways to think about it. We've all heard of, Dr. Jekyll and Mr. Hyde. Well, that's kind of the way maybe they think about this administration. So, first we kind of had, Mr. Hyde, the kind of crazy or kind of more extreme individual. And now we have Dr. Jekyll is kind of, the one now kind of calling the shots. And what we had done is we had, on market trends some time back, we had talked about how Scott Bessent had kind of been calling the shots more, and the tide shifting from Scott Bessent, from Peter Navarro to Scott Bessent. And I think that's really the key thing now, is that this sort of foray into tariffs, while some of that might remain, for now, the market perceives that the pendulum has swung, and there are, political things happening. And if the tide turns to other things like tax cuts, deregulation, other things like that, then things like tariffs, which have caused disruption and anxiety, may have, kind of played out for now. And if that is the case, it does mean the market is going to be in a different place. So I think it's important to realize that. Another thing that's important to realize is that we are rallying on hawkish monetary news. So basically, we now see, this is CME's FedWatch tool, and we can see now that we have lost a rate cut in June and even July, the first rate cut now, maybe, according to this, 52% of it occurring at the meeting on September 17th. So this is interesting to see the market rallying as rate cuts disappear. The Fed stood their ground hawkishly, and they continue to do so today. I think today we had Adriana Kugler basically saying hawkish things. So essentially, the Fed did not back down. So when you look at this in many ways, the economic orthodoxy of Wall Street has won. Um, there's no more talk about firing Jerome Powell, and now there's less thought of significant tariffs. So that's what I mean. A return to normal trade is kind of what's been happening here. Now, another thing I want to just very briefly look at is let's look here at the gold miners. This is the S&P, but first I want to mention, last week we had talked about the GDX and the gold miners. Actually, you know what? I always got to think of the right chart to use for this. I'll use this one. This is a GDX. This is a weekly here of the GDX. Now, we had kind of talked about, the fact that this thing was forming a channel. And on our Thursday webinar, we had mentioned the fact that this might be setting up for, some downside if the economic news moves in a good direction. And that is what has been happening. So it's kind of interesting to see that kind of as we had anticipated. But the bigger thing I think is also important about this, we can look at gold itself. You can see gold here potentially settling into a range for a while. This is a daily chart of gold, but you look at this, and I think if you look at, the extent of this kind of move, and then even look at this on a monthly, people might be looking here and saying, this move in gold, I mean, basically from, it's a pretty significant move from under 2,000 in late 23 to over, 3,400. I mean, it almost doubled. I mean, it really almost doubled pretty much. This might be something where people might say that gold is kind of done for a while. And if that is the case, that would also fit into this environment of basically back to normal, and this idea of the sell America and all that sort of narrative fading for a while. And I think it's important to realize that because, we were early to identify the fact that there was this huge sell-off in the dollar. We were talking about it back here, and we talked about how unusual it was. But now that is going into reverse. So this is exactly what we had discussed on Thursday on market trends. And so this is now just kind of playing out. So I want to confirm all these intermarket signals are pointing in a kind of similar direction here of a back to normal trade. And I think we have to realize here also that there are some underlying positives that remain in effect in the market. We mentioned it a little bit in this article, but one of them is that earnings growth now, according to FactSet, it was around 13. You look at this here. So the profit growth in the first quarter accelerated to 13.4%. Now, if you go back a few weeks, it was 7.2%. Then the next week, the later week, it was 10.1. The following week, it was 12.8, and now it's 13.4. So way back when tariffs started, we were talking about how earnings estimates are going to come down, and they did. They went from double digits to single digits. And now what we've seen in the last few weeks is that, guess what? They're actually doing better. So now we have earnings beating to the upside. We have less than average weak guidance, which is interesting. So we actually have the fundamentals, the corporate earnings and those sort of things pointing in a positive direction, despite the fact that we have the tariffs were there. Remember, we had Meta and Microsoft with bullish commentary on AI investment. So that was a big thing. So I think here we're in a spot where the news is breaking in a positive direction. The Fed is hawkish, tariffs are going down, and earnings are beating. So those sort of things overall actually put us in a spot where, ideally, long term, you don't want the Fed cutting. You want the Fed to cut when we enter a real recession. And the more that dry powder is out there, the better off. And the other thing is that in this sort of environment with rates kind of staying high, it favors the old, standard, the old kind of model, which is big tech growth, and less of the kind of small tech or small caps, less of the things like gold and foreign stocks, and more of just your classic kind of NASDAQ large cap growth stocks. That is what this environment favors, and that is really where the big part of the market is. So I think it's important to realize these things are structurally positive overall, and in many ways, the strength of earnings and the lack of bad guidance, given this tariff environment, I think is just right now something that shows just the kind of absolute beating that sentiment took and the inability of the facts to follow through, this is the sort of thing that in many ways could suggest that this market still has, some upside here. And I think it's important to realize is that the sentiment was extremely negative and is not being confirmed. The other positive that remains out there, we talked about a lot, is just the fact that there is that potential here that the base effect and shelter cost will create a disinflationary force as the year plays out. And I think that's another thing that is kind of out there that we need to remember. So we're in a spot here where the next thing after that is NVIDIA reports earnings on May 28th. So this creates an environment here where, just very quickly look at NVIDIA. This is just a daily, this is the advanced decline line, which I'm going to get to. But NVIDIA here reports earnings on May 28th. And, there's a lot of positive overall right now. There's a Morgan Stanley note that said that there are strong shipments for this new AI rack that they do. I don't know if it's exactly a chip. It's something called the GB200. I don't know if it's a chip or if I think it's an actual, like, some kind of computer. But the key thing is that all the negativity about chips being bad, that is, now going the other way. There's the Trump is going to loosen the rules on AI chip restrictions with China. Remember, he was about to go the other way and be more aggressive, blocking all. Remember that NVIDIA had that big charge. Now the whole pendulum is swinging the other way. We also have, for example, well, that was actually, we had the NVIDIA earnings, and we had the easier restrictions on Trump on the AI chip rules. We also have a series of IPOs coming in the next few months, which in many ways, that sort of thing can create a sort of overall positive glow in something like technology here. The other thing is it with an easing of relations with China, a lot of these sort of Chinese technology stocks may potentially be something people come back to, and those are a high beta version of the NASDAQ. So these are all potential positives now across technology that I think are coming back, and we could be entering a period now where it's very much the sort of thing of a lot of the kind of small nuanced growth stocks, like Cathie Wood often would be associated with. Those sort of names in this environment could potentially perform, because we are in right now the stock picking environment, like we had said before, with our volatility cycle. So this is an environment here, I think, where we have to realize is that basically, things like technology, less of the macro trade, and a kind of sudden, unexpected return to normal is kind of what, might be just we're waking up from this nightmare, and it's a return to normal. And as strange as that might be, that's what the market seems to be kind of telling us here. All right, so now we'll get to the individual indexes as we always do. I think the main things I did your trading view idea on the gold miners. If you want to check that out, we did share a link to this. We don't really get into gold too much in this, but I did want to mention it. So look at the S&P here. So this is just a dollar index, just to remind you, this was what tariffs did. People hammered the dollar. They sold bonds, they sold stocks, they sold America, and now they're saying, oops, never mind. Now we're doing the opposite. We're putting all those traditional positions back on. And it's just kind of like a return to normal, so to speak. Hey, NVIDIA reports earnings in 2 weeks, and all that tariff stuff. Well, we're moving on, and that seems to be where the market is now. So look at the S&P. Now, from my view here, the overall kind of view of the S&P, like I said, volatility falling. We're entering that period of stock pickers market, away from correlated volatility, correlated index-based moves. So in that environment, you see the S&P here cleared this level we had pointed out. And I think from my perspective here, this can, potentially sit. Now we look at it on the daily chart. I'm going to actually remove this. And let's show you a few things on this chart that are interesting to me. One of them is basically this candle. You can see we had been stuck in the candle from before Liberation Day, and we broke that. Now we're clearing above the high from March. So from my perspective here, when you see MACD rising, what's interesting is that RSI is not yet overbought. So at this point, the market could maybe, people might look for a day or a couple of days of sideways movement of just consolidating here. But here's the key thing: the advanced decline line hit a new high. This is pretty amazing. The advanced decline line hitting new highs when the S&P is nowhere near new highs. So this is not necessarily a bearish sort of indication. So this is the daily of the S&P here, and I'd say from a weekly, when you look at this, there's potentially space, all the way up through these ranges here. And from my view, if any level now emerges as the next kind of resistance, it would, could potentially be essentially, I would actually say at this point, the thing to do would be to, let me remove that, is to basically move our zone essentially up here between these two weekly closes. That to me, but even then, I think it's, you know, it could be a slow grind upward, and then also to realize now that we might see under certain environments, this level around 57, that I'm going to put on that high. I'd say basically the low right around kind of 56.67, which was that weekly close back in early March. You also have this high here from the last week of March. Um, this range right around 5,700. We had said at the time 5,700 was a new 6,000, and I think this is an important level here. So people might look for some testing down to this environment. However, I think we also have to realize that it will require this point to have even a drop of that much. When you look at VIX kind of coming in, it's not really even looking for a test down to that level. I'd say that there might be something where if something really bad comes out, people might look for that level, but even then expecting it to be tested is not necessarily, I think, it's not maybe the main thing that people are going to be expecting. Now remember, we have CPI in the morning, and we also, we could get some, I mean, I've said it a few times, and it's a hard thing to think about, but we could get some judicial, rulings on these tariffs, because now there's actually the beginning of oral arguments in one of the cases, and there are going to be other cases. So, I mean, the judiciary is its own animal, but there very well could be things coming down because multiple states are suing over these tariffs, and maybe by them going away, those cases go away. But there could be some news as well, and I think we just have to kind of remember also at this point that there are other things out there, and many of them might be more in a favorable position, anti-tariff kind of position. So RSI on the daily chart, not yet overbought. Advanced decline line hitting new highs. MACD steadily bullish. So at this point here, it's kind of extended to the upside, but at the same time, people might look for some stability. And this is a sort of environment when you get this big move up and then the index maybe doesn't do anything for a certain period of time, but individual names can move. And that's, I think, kind of the model I'm working with here. So we look at the Qs now, and it's a very similar environment here. We're essentially in the Qs. We have a level here around 511, which was kind of around the lows back here in January, early February. But I think also with NVIDIA reporting, this is something that might simply have space here to the upside. The worst case scenario for Apple is probably kind of gone for now. So you have Apple, at this point, probably at the worst of its China problems might be over for now. And then NVIDIA reporting, Microsoft had a good quarter, Tesla's rebounding sort of. So at this point here, from my view, this is a level at 511, but people might look for this just to melt all the way back up to those highs, where we were before this whole drama started. Because don't forget, we've had significant earnings growth in that time. We had Meta and Microsoft confirming what was happening with AI. We have IPOs coming. And we basically have easier chip rules as well. So all those things have kind of, amid this turmoil, those things have happened that kind of might give some fundamental, positivity here. That is the Qs. Now, the Dow is also in a spot where, people might look here for this level. This was the weekly close, this kind of 42,774. This level was kind of a weekly close in late March, and then the high again. We see this level on a lot of charts where it came down that first week of March, chopped, tested up, turned that resistance into support. So from my view here, this is also the key level to watch. It maybe is kind of resistance here on the Dow. Now, the Russell is also back to an important level here. Now, I think the thing about the Russell that's a little bit tricky that we have to be careful of is the fact that we are now in a more hawkish environment. So I think people might want to kind of, this might be on the Russell, you know, a spot of people looking for some resistance here. So I want to just kind of point that out. The lack of dovishness might really weigh on the Russell as time moves forward. And this could be something that it's had a decent bounce, but it continues to face that macro environment. Remember, this is still trapped below these old levels here. And if we do go back to the old, mantra of large cap growth and that sort of trade, the Russell has not performed well in that environment. Now, the 10-year TNX remains, I think, an important thing to think about. Now, I have said all along that my I think, in my view, the nightmare scenario for bulls is that this runs away, to the upside. There are reasons to be concerned about the 10-year Treasury yield. The situation like we saw with with tariffs and foreigners not wanting to buy, foreign central banks, etc., China, others not wanting to buy our dollars and our treasuries, that creates risk. The fact that the United States really faces a pretty massive fiscal challenge at this point, and some of the deficit information we've been seeing is not positive. However, in many ways, the fundamentals on treasuries don't always apply. They normally don't apply. They normally apply based on the kind of view of things like inflation. And at this point in time, like I said, I think we have that base effect sneaking through. We have what is in many ways a hawkish Fed, but it's not necessarily a bearishly hawkish Fed. It's actually, in some ways, a bullishly hawkish Fed, because essentially the Fed not cutting and the economy not needing it, and nobody really needs the Fed to cut rates at all. And that's actually where you want to be, because then when the recession does come, then you in that spot when you can cut rates. And on top of that, it basically gives credibility to the United States. It gives credibility to the dollar and to our inflationary environment. So from my view here, this we might see a test up toward between 460 and 465 on the 10-year. And I think that, as that kind of happens, we kind of melt higher. That would be a drag on small caps. However, it would not be a drag on the Qs, on the NASDAQ, on technology. And I think that's really what matters here. And I think that's why that kind of focus on some of these software chip stocks, some of these communication stocks that are kind of coming along, things that, reported earnings recently, some of these different technology stocks and the growth stocks here, that is an environment where they can survive rates moving higher. Small caps more likely to struggle in that environment. So that's the TNX. I mentioned the dollar index. From my view here, the main thing is that it held. I don't really care much about it beyond that. I think the main thing is that we're not in the Armageddon scenario of the dollar crashing and turning into like some emerging market currency or Turkey or something. That was the fear, and it's not happening. And that's really the only thing that matters about the dollar index here. I would say that the dramatic outperformance we saw in international stocks, EFA, for example, all these things here might also be something with some significant kind of pause. Things like gold and all these things, these might enter a multi-month period of consolidation and kind of drifting as people come streaming back to the traditional standbys of large cap growth. So I think we have to realize that we don't only get too much into global here, but this whole narrative of like rotation to global and all of that could be one of those things where people feel very, it might not. You just gotta be careful of the horses out of the barn and all that sort of stuff. Now, XLB materials. Now, I think this is something here where, it's interesting to see this break here. And from my view here, materials, XLB is kind of a real messy sort of, I don't know. It hasn't been a great thing overall for trading in my view, but I think to take the cue of it here that it's basically breaking this line. I'm kind of looking here at some individual names that really stand out to me. I'm going to take off this advanced decline line because it's only, but look at Alcoa here. I mean, I think right here, there are going to be some of these names that people might look to. Another one I look at sometimes is PKG. it's a packaging stock, but sometimes this name can actually be very interesting. And so I think right here, as we go back to normal and we say recession's not going to happen and all that sort of stuff, some of these materials might actually surprise to the upside, but it might not be, like the steel makers that everyone, kind of sees. I don't know. I've been looking at the steel makers and I don't see much on them. I want to just kind of mention that. But I do see that Alcoa, has this interesting pattern that is breaking above the top of. But to see XLB breaking here, from my view, this is also one that might just kind of melt higher. XLB itself is a strange sort of sector itself, but some individual names. And another name to watch could be Freeport, FCX. I mean, I just want to mention it. It's one that is highly active with options traders. And this is also one where it's kind of extended here. But again, and I'm not going to really get too much into individual stocks. This is a highly active stock, copper stock with Chinese exposure. And this is, I think, one also here that looking around in the world of materials might actually be something people start to do. Now, XLC Communications, this now has broken this falling trend line. And when you look at it, there's a little bit of resistance here. This kind of, again, this level from early March, late March. Again, on this chart, it's right around 100. But again, this is something here I think people might look at and really not see very much holding it back in terms of space to the upside on XLC. Now, energy remains kind of interesting to me here. And I think we had talked about how it did not break to the downside. And from my view here, I think energy is something that there was so much negativity in it, and OPEC increased production and all that sort of stuff. But, this now might have gotten to the spot where it has moved a lot in one direction. And so I think at this point, energy might have space all the way back up this range, the XLE. I mean, we had mentioned how a lot of the bad news really now seems to have played out for oil. And as people look for the recession not to happen and look for China not to have, the worst case scenario, something here like energy has that potential. And also the other thing is that these trade by far at the lowest multiples in the entire market, the lowest valuations. Um, Financials here are very similar to communications. They're pushing at this level. In fact, it's interesting. They're all the way back to this more or less that high from March. But I think also nothing really stopping. There's no clear sort of obstacles to this moving back toward the highs. Industrials here really came to life when we had talked about it, and some interesting numbers. Some of these sort of companies with exposure to data centers and different AI related things, even though they're industrials, very strong. Look at a name like APH. I mean, this is a name that most people probably have never looked at, but Amphenol, APH, they do cables and Ethernet cords and stuff like that. But I mean, very strong earnings, data center sort of AI infrastructure in this name. And this is an industrial. So I did want to mention some of these things happening here. APH, XLI, now XLK. I mean, again, NVIDIA reports earnings on the 28th of May. And what else is there to know, really? I think that's kind of where we are here from my view here, again, it has, dropped significantly. But when you just look at it technically in the kind of turn of the tide in terms of the news and sentiment, people might also see space back to the highs on this without much really slowing it down along the way. That's technology. XLP, safe haven, which is not necessarily what people want in a market like this. So this is actually interesting to see it kind of making a lower high here. And people might say, you know what, I see the beginning of a downtrend here. So one just kind of mention that in a kind of safe, in this kind of market, something like consumer staples are not necessarily where people typically would focus. Now, real estate also is kind of in that spot. And I think, like I said here, we're kind of in a hawkish environment here. And we have to be careful, I think, with things that are interest rate sensitive in a hawkish environment. So from my view here, XLRE also kind of stalling at resistance. Now, we also have the potential of some downtrend happening in this. So I think this here is just something where we probably need to see the 10-year get up to 4.65 and die, and then start moving lower before people really going to want to be focusing on real estate. I think, like I said, also, we seem to be in a period here of home prices are falling, even though most REITs are not exposed to residential single family. If you're in a spot where residential single family is crashing, which we could be starting to see, maybe not crashing, but we are seeing falling prices for single family. If that happens, it might not be a great place for people to be in, real estate investment trust. So from my view here, this is something where we might need to work our way through this, and maybe in a certain period of time we enter a recession, maybe several months or quarters or years from now, but we might need to enter a dovish period for this to perform. And right now, it doesn't seem to be a dovish period that we're entering. Now, utilities are kind of similar. They do have a little bit more of this sort of dynamic growth story with AI. From my view here, though, this is something where this could just be kind of hitting your head against the wall until this really breaks out. So from my view here, we have some resistance across here, and that's really the way to kind of think about it. And I think that right now people might want to be simply saying, 80 up to 84 is not a huge distance, and maybe the thing that will save people a lot of gray hair and frustration is just waiting for a breakout to new highs on this, because this is something here that with the hawkish monetary environment, it could just be in a staggering sort of situation. Now, healthcare has just all kinds of bad news in it right now. Trump wants to force down prices on certain pharmaceuticals, and then on top of that, they have this new gentleman in charge of vaccines at the FDA who is not a big fan of vaccines. His name is Vinay Prasad, and so right now, healthcare also safe haven, non-cyclical. This is something here where people might see this just continue to stagger and potentially even work its way down toward these lows from all the way back in 2023 here. So I think right here, healthcare is something like consumer staples. The macro environment, with the risk on sort of environment, does not necessarily favor. XLY, on the other hand, this is consumer discretionary. You got Tesla and Amazon, and this is kind of in a spot also where the next spot of logical sort of where it might want to stop would be around 218. And it's interesting also because that was the high from all the way back here in 2021. So from my view, 218 on XLY is kind of the spot that kind of stands out. So it's great talking to everyone. Remember, we will be back on if you go here on Trade Station and you go to Learn, and then you go to Events, you can see we also do the webinars on Thursday if you want to sign up there. But we will be doing market trends on Thursday at 2 p.m. So that's the next one we're going to be doing here. I hope everyone, it's coming up. Let's see, here it is. And I hope everyone has a great day, and we'll see you guys on Thursday at 2. Take care.